Good afternoon. This is Matt Carberry, Ridgeline Financial Partners. This is Matt on Money. It's been quite some time since we've done one of these. We hope that you and your family is staying safe and well during these difficult times, although it's nice to see that we're starting to see a light at the end of the tunnel. So let's all hope collectively for that. But in this episode of Matt on Money, I'm going to talk about a couple of different things. One, for those of you who haven't been sleeping for the past couple of months, we had an election and we then had a subsequent runoff election. And I want to give you my perspective on that, and I want to talk about the markets and how it relates to what's going on in Washington. We'll talk a little bit about potential tax changes that have been proposed. And then lastly, let's talk a little bit about the madness that's going on right now in the markets in some of these select names like GameStop and AMC and BlackBerry and Bed Bath & Beyond and Silver and a bunch of other ones. So this is Matt on Money, February edition. Thanks for tuning in. Okay, so we had an election and we have a new president. We also have a new Congress. And the one thing that I have said to people leading up into this election, and a question that we got commonly is, what happens, Matt, if? And if I use history as my guide, which I think is an important compass, what I will say to you is that Washington and what happens in Washington doesn't necessarily translate into what's going to happen in the equity markets. If you go back and you look at the returns of the US stock market as measured by either the Dow Jones or the S&P 500, what you're going to find is that there is not one political party where the returns that were experienced during that 4-year presidential tenure was much better than another. There are some periods under Democratic leadership where markets did incredibly well. The Jimmy Carter administration, interestingly enough. And during some Republican-led presidencies, you had some of the worst performance that we've ever had. The Nixon era, the George W. Bush era. So let's not let what's going on in Washington determine our investment thesis or how we invest or whether we try and time the market. It's not a prudent thing to do. I do fully understand that in this day and age, politics are very polarizing and people have very strong opinions. But when you let that start to get into your decision making about how you invest your money for your future, it can cause more damage than good. So let's remember this in light of the election, in light of the fact that we have Democratic leadership in the White House, we have a majority in the House of Representatives, and we have a 50-50 Senate with the controlling vote held by Vice President Kamala Harris, that doesn't necessarily mean that it's the end of the world and that as investors, we need to completely change our investment philosophy. So let's stay on the theme of a Biden presidency and what that could mean in terms of taxes and what that could mean about legislative action that may affect you as an investor. I am of the opinion that even if we were dealing with a Donald Trump second term presidency, that there is no choice but for us to have higher taxes in the future. Now, when they talk about higher taxes, we often have clients that go, oh my God, Matt, higher taxes. I can't pay any higher tax than I already pay. Well, just take a look back at what tax rates were in the 70s and in the 60s. We had a highest marginal tax bracket of 90% at one point. Now, granted, very select few most likely paid tax at that rate. But when you read the Biden tax proposal, what you're hearing is that people above 400, maybe 450,000 of income are those that are going to be impacted. So let's fully understand what this means to you. Let's not understand what you're hearing from the various different news outlets. I do feel that we're going to have higher taxes. I feel that a very small percentage of the population is going to be affected by that. What happens with capital gains to be seen? Could that rate double? I don't think so. Could it get to where it is now at its highest point, which is 20%, and be somewhere in between what Biden originally came out with, which was 39.6%? Sure. A lot of talk about 28%, which is what it was during the Reagan administration. So I think as Democrats think about policy and formulating legislation, that's a very easy thing to point to. It wasn't so bad back then in terms of the country's prosperity during the Reagan years. Are there going to be changes to other tax and estate planning thresholds such as how much money you can leave to the next generation. Most certainly. There's going to be change, but what I'm saying to you is that that change is very likely to affect the top 1% to 2% of taxpayers. So if you're trying to better understand where you are going to shake out, if some of this does get implemented, some of the original Biden tax proposals that he put together, contact us. Let's kind of sort through the information. Let's talk about your situation individually, and let's block out some of the noise. Okay, so how about the most interesting calls that we're getting these days from clients who are wondering if we took all of their retirement money and put it into stocks like GameStop and AMC and Bed Bath & Beyond. Why do I bring up these names? Well, if you've been following what's been going on in the markets, we have seen, and I have seen in my 19 or so years in this business, an event that I never thought I would ever see. And what transpired was the names that I referenced, and there's more that are on that list, are some of the heavily shorted names, the most heavily shorted names in the stock market. Now, what I mean by short is that you have investors, predominantly very large institutions and hedge funds, that make seismic bets on a company's stock price going down in value. They're betting against what most traditional investors are betting on, which is that stocks will go up in value. So the short interest on some of these stocks was more than 100% of the outstanding float, the outstanding amount of stock that's out there. Now, how could that be possible? How could you short more stock than exists? Well, there's something that is called leverage in our industry. And it's a term that effectively refers to borrowing additional money to double down on a bet, to triple down, to quadruple down. And a lot of these hedge funds do that because it can potentially accentuate and increase the return. Well, the opposite could happen. The rebellion, the revolution that was posed by a bunch of online chat room followers, which was to go after these shorted names, to turn around and buy them and drive the stock price up, force these short sellers, who again are borrowing stock with the hope that it goes down in value and they'll profit on the difference. That's really the loose definition of short selling. They had to go back in the market to protect their positions, because the higher the stock price goes up, the larger their loss gets. And when you factor in borrowing to only increase that bet, these losses became dramatic. So you had billions of dollars changing hands from hedge funds and institutional investors and making their way into the hands of millennials and day traders. So my opinion on it is that I think it's great. I don't believe in short selling. I don't think that investors should short sell. I have personally never taken a short position, and I never will. We believe in long-term investing, diversification, asset allocation, being tax efficient as we can. Is this the end of this? It's not. I am scared that a lot of investors who have jumped into these names have no idea what they're doing. You have to remember that stock prices ultimately come back down to what the stock price is relative to the expectation of that company and the expectation of their forward earnings. So to have a stock like GameStop go from $20 a share to $400 a share defies logic. What did GameStop do that made their stock worth that much more? Nothing. The stock was driven up purely on speculation, purely on supply and demand. It will most likely end up back at its normal resting spot at some point, and those that got in late to the party, unfortunately, could be left holding the bag. So lesson learned here, short selling is very dangerous. Using margin or leverage is equally, if not more dangerous. Investing for the long term is still the proven way of doing things. Thanks for paying attention. Thanks for tuning in. We greatly appreciate the trust that you bestow on us to guide you through this crazy journey that we're on called life. This is Matt on Money. We'll see you hopefully next month in March.